All right, welcome back to the deep dive. Have you ever looked at something, maybe a vintage car, that new tech gadget everyone's raving about, or even the stock price of a company, and just wondered, what is this really worth? Like, objectively, not just what someone paid last week or what you hope it'll sell for, but its true unvarnished value right now? It's a surprisingly tricky question,
Yeah.
especially in the world of finance. Okay, so let's unpack this. Today, we're diving deep into the, well, surprisingly precise world of fair value measurements. We'll explore exactly what fair value is, why it's absolutely crucial in finance and business, and how it's meticulously determined. Our mission really is to turn what might seem like dense accounting rules into those, aha moments that genuinely help you understand the financial world around you.
Exactly. And this deep dive, it'll offer you a really clear roadmap through the fundamental principles, the ones that ensure financial statements truly reflect the economic reality of assets and liabilities. It's a critical piece of business literacy. It helps you understand not just how companies are valued, but also how transparent and reliable those valuations actually are. You'll basically gain a new lens to view financial health, large and small.
Okay, so let's start with the big picture here. For those of us who follow finance, we know consistency is, well, key. But just imagine a world before standardized rules for valuing assets and liabilities.
Hmm.
I mean, every company, every investor, they could just invent their own idea of what an asset was worth. It would be total financial chaos, right? You wouldn't know if Company A's reported assets were truly comparable to Company B's. That's where U.S. generally accepted accounting principles, or GAAP, steps in. It provided this powerful standardized framework, sort of like a universal language for valuation, specifically around this idea of fair value.
Hmm.
Now, while U.S. GAAP gives us this sweeping framework, it's not applied absolutely everywhere. There are a few very specific areas where this fair value standardization doesn't apply. Usually it's because other equally rigorous standards already exist for those things. So, for instance, it doesn't cover share-based compensation, like employee stock options. That stuff has its own really detailed rules.
Right, specific guidance for that?
Exactly. It also doesn't apply to measurements based on vendor-specific objective evidence of fair value VSOE, they call it sometimes.
Yeah.
These are often unique, kind of contractual arrangements, not broadly subject to market pricing.
Mm, yeah.
And finally, it doesn't dictate fair value measurements for lease classification or how leases are measured, again, because there are other very specific guidelines already in place for those complex transactions. So these exceptions exist mainly to prevent, redundant or conflicting guidance. They've already got their own rule books, basically.
Which makes sense.
Yeah.
And what's fascinating here really is how incredibly precise the definition of fair value actually is. It's not just any price or some arbitrary number plucked from thin air.
Yeah.
No, it's a very specific construct designed to reflect real-world market reality as objectively as possible. Let's break down this core definition piece by piece so you can really get a feel for its nuances. Okay, the first part says, the price that would be received to sell an asset or paid to transfer a liability. Now, this is absolutely critical. It defines fair value as an exit price.
An exit price. Okay, so not what you paid for it originally.
Exactly. Not the price you paid to acquire something that would be an entrance price or historical cost. Instead, it's about what you would get if you had to liquidate an asset or, what it would cost you to settle a liability right now. This distinction is crucial because it focuses on the current market's willingness to buy or take on that item. It reflects its immediate liquidity and current worth, not its historical cost. It's like finance's snapshot of reality for that specific item at that specific moment.
Got it. Snapshot, exit price.
Then the definition continues. An orderly transaction.
Orderly. What does that imply? Not like a fire sale.
Precisely. It's not a fire sale or a forced transaction where you're desperate to offload something quickly because you absolutely have to. An orderly transaction assumes there's been sufficient marketing time, enough time to allow for the usual and customary activities to find a willing buyer or seller. It's a calm, considered exchange, not one under duress. Think of it like a carefully planned open house for your property versus, say, a desperate auction to cover a sudden debt. One lets the market truly discover the value, the other kind of distorts it.
Okay, that makes sense. Sufficient time, no panic.
Right. Then we get to whip between market participants.
Ah, the mysterious market participants. Who are these people?
Well, they're not just anyone. The definition is quite specific here, too. They're independent parties, meaning they're not related to you or connected in a way that might distort the price. That ensures objectivity.
Right, no sweetheart deals.
Exactly. They are knowledgeable about the asset or liability, so they understand its features, risks, potential uses. They've basically done their homework. They are able to transact, meaning they have the legal and financial capacity to actually do the deal. And importantly, they are willing to transact, acting voluntarily, not under compulsion. And finally, they are considered to be acting in their economic best interest. They're rational actors trying to maximize their gain or minimize their loss.
So it sounds like we're imagining these ideal, almost perfectly rational actors in the market. But, in the real world, aren't markets sometimes driven by emotion or speculation, not just pure economic self-interest? How does fair value account for that human element, or does it try to filter it out?
That's a fantastic question. And it really gets to the heart of the, let's say, idealized nature of fair value. Fair value attempts to filter out those emotional or speculative distortions. It does that by focusing on the orderly transaction and these willing, knowledgeable, acting in best economic interest market participants. It's fundamentally a theoretical construct built on the idea of a rational market. Now, while real markets can be irrational in the short term, absolutely fair value aims to capture the sort of longer-term fundamental value that rational, informed players would agree upon under normal conditions. It's less about capturing momentary hysteria and maybe more about fundamental economic worth.
Okay, so it's aiming for objectivity, even if reality gets messy sometimes.
Precisely. Okay, moving on. The definition also includes in the principal or most advantageous market. This is key. It tells us there's a kind of pecking order for markets. We'll definitely dig deeper into this one soon, but for now, just understand we're looking for the market where the most activity happens for that specific asset or liability.
The main market, essentially.
Basically, yes. And finally, at the measurement date under current market conditions. This highlights the snapshot in time nature we talked about. Fair value isn't some static number that lasts forever. No, it reflects the prevailing conditions of the market on that exact day the measurement is made. Things like interest rates, economic news, supply and demand, even geopolitical events, all of that can factor into the value at that specific moment. It's dynamic.
Right, not fixed. It changes with the times. So for you, the listener, the real takeaway here is fair value isn't about what you paid for something or what you wish it was worth. It's finance's snapshot of reality, what the market, under these sort of ideal objective conditions, would pay for it right now. It's an objective external perspective derived from real market behavior on what that asset or liability could fetch if it were exchanged in an ideal structured way.
Absolutely. And building on that core definition, there are a few foundational principles that really guide fair value measurements. Firstly, it's always about a specific asset or liability, or maybe a group of them, or even an entity's own equity instrument. We're talking about precise valuations here. So, for example, it could be a single piece of specialized manufacturing equipment, or an entire portfolio of bonds, or maybe shares issued by a company as part of a business merger. Each item needs its own fair value assessment.
Very specific.
Yes. Secondly, and this is truly crucial for understanding financial statements, fair value is a market-based measure, not an entity-based measure.
Okay, what's the distinction there?
It means it's about what the broader market dictates, based on the actions and assumptions of all market participants, not what a specific company wants or needs, or even how that company uses the asset internally. So, for instance, a company might value a piece of land based on its specific factory operations that only make sense for them. But the fair value would look at what any market participant would pay for it, potentially for a different, maybe more lucrative use. This objective external lens is vital. It removes any bias tied to a specific entity's unique circumstances, giving you a truer picture of the item's worth to the world.
That's a big one. Market view, not company view. Got it.
Thirdly, a fair value measure should reflect all assumptions market participants would use when pricing the asset or liability. And crucially, this includes assumptions about risk.
Risk. Why is risk so important in pricing?
Well, because market participants factor in the uncertainty of future cash flows or the likelihood of an obligation being fulfilled. It's fundamental. A higher perceived risk associated with an asset generally means a lower value to a potential buyer. They'll pay less because it's riskier. Conversely, for a liability, higher risk means a lower cost to transfer it, because a market participant taking on that risky obligation would demand a discount. Risk always demands a price, essentially.
Higher risk, lower value, or lower cost to transfer. Makes sense.
Fourthly, here's a nuance that often trips people up. Fair value does not include transaction costs, but it may include transportation costs if location is a key attribute of the asset.
Okay, hold on. No transaction costs, but maybe transport costs. Explain that.
Right. Fair value represents the price at the measurement date. Transaction costs, things like brokerage fees for selling stock or commissions for selling real estate, those are separate expenses incurred to engage in the transaction. They don't affect the inherent value of the asset or liability itself.
Okay, so the broker fee is separate.
Yes, exactly. However, if location is crucial, say, with a rare antique located across the country that needs special transport to reach its primary market, those transportation costs are sort of embedded in what a buyer would be willing to pay or receive, because the asset's location directly impacts its usability and market access, and therefore its value. The cost of getting it to the market is arguably part of its market value in that specific location context, but the cost of transacting in that market, like the commission, is separate.
Oh, okay. Subtle but important. Location matters for transport costs.
Precisely. Fifth, for non-financial assets, fair value assumes the highest and best use. This is a really compelling concept. It's not just about how the asset is currently being used, but its potential to generate the maximum economic benefits. So if a piece of land currently holds an old warehouse, but new zoning changes make it prime for high-rise residential development, its fair value would consider that more profitable potential use, even if the warehouse is still standing. It forces us to think about potential.
Highest and best use, even if it's not being used that way now.
Interesting. Sixth, for liabilities. Fair value includes non-performance risk.
Non-performance risk. What's that exactly?
It's essentially the risk that the company obligated to make payments won't actually fulfill that obligation. The risk of default, basically. So if a company has debt and there's a risk it might go bankrupt and not be able to pay that debt back, that risk is factored into the fair value of that liability. A higher non-performance risk for a liability would mean that the fair value to transfer it would be lower. A market participant would pay less to take on a risky obligation. They'd want a discount because the debtor might default.
Okay, so the risk you won't get paid back is priced in.
Yes. Seventh, the fair value of an entity's own equity instrument, like shares issued in a merger, is measured from the perspective of a market participant who holds it as an asset. This just ensures consistency. You're valuing your own stock as if someone else were buying it in the market, not from your internal perspective as the issuer.
Consistent perspective. Makes sense.
And finally, fair value measurement assumes that a liability or an entity's own equity instrument is transferred to a market participant at the measurement date, and that liability or equity interest would remain outstanding. It wouldn't be settled or canceled on that date. It's a hypothetical transfer. You're valuing what it would cost to pass the obligation or the equity interest to someone else, not what it would cost to make it disappear entirely. Keeps the perspective consistent with a market transaction.
Okay, so it assumes the obligation continues, just with a new owner.
Exactly.
Okay, let's unpack this further. We've got the core definition and principles, but let's really break down some of those key terms that make this definition so robust and ensure its precision. Understanding these specific terms, I think, is essential to truly grasping fair value measurements in practice.
Agreed. Let's start with orderly transaction. We touched on it, but it's worth expanding on. An orderly transaction isn't just about avoiding a fire sale, like we said. It explicitly means the asset or liability must be exposed to the market for a period before the measurement date. And that period needs to be long enough to allow for marketing activities that are usual and customary for that type of asset or liability.
So the time needed depends on the asset.
Absolutely.
Oh.
For a publicly traded stock, that might be mere seconds, right? But for a complex, one-of-a-kind piece of real estate, it could legitimately be months, maybe even longer, allowing for proper marketing, due diligence, showings. The key is that there's a proper, fair process to discover the market price. And crucially, an orderly transaction cannot be a forced transaction.
Oh.
To give you a clear image, a homeowner frantically selling their house at a deep discount because of an imminent foreclosure. That's forced. An orderly transaction would be that same homeowner taking their time, maybe making minor repairs, listing with an agent, allowing for showings, open houses, negotiations, basically letting the market properly discover the price without duress.
Right, no undue pressure affecting the price.
Exactly. Next, let's detail market participants again. These are the hypothetical, rational actors whose collective behavior determines fair value. We said they are buyers and sellers who are independent, not related parties. Fundamental for objectivity. Selling to your cousin might not reflect true market value.
Keeps at arm's length.
Right. Knowledgeable about the asset or liability. They understand its features, risks, potential uses. They've done their homework. Able to transact. They have the legal and financial capacity. They're qualified buyers or sellers, willing to transact. They aren't compelled or under pressure. It's voluntary. And finally, acting in their economic best interest. They're rational, trying to maximize gain or minimize loss. calculated decisions. These characteristics together ensure fair value is a robust, market-driven measure, free from personal biases or forced circumstances.
Okay, the ideal market player profile. Now, here's where it gets really interesting, I think. The hierarchy of markets themselves, because it's not just about what the price is, but where that price comes from and which market's price truly holds sway. This next part, the hierarchy of markets. Yeah, I found this particularly fascinating.
Absolutely. The framework distinguishes between the principal market and the most advantageous market. The principal market is defined as the market with the greatest volume or level of activity for that specific asset or liability. Think of it as the main hub, the go-to market where most transactions for that item happen, and its dominance is paramount. If a principal market exists, its price is the fair value measurement. Full stop. Even if another market might offer a slightly better price on paper.
Wait, even if another market gives you more money?
Yes. The reasoning is that the principal market, because of its high volume and activity, inherently reflects the most reliable and broadest consensus of market participants. It's the market speaking loudest, you could say. There's a crucial caveat, though. The reporting entity must have access to this principal market at the measurement date. If you can't actually trade there, it can't be your principal market.
Needs to be accessible. Got it.
Now, if there is no principal market for an asset or liability, then and only then do we look to the most advantageous market. This is defined as the market with the best price, meaning it maximizes the selling price of an asset or minimizes the payment required to transfer a liability. But here's the critical detail, the tricky part. This is determined after considering transaction costs.
Transaction costs pop up here.
They do, but only for choosing the market. While transaction costs are used to determine which market is the most advantageous, they are not included in the final fair value measurement. The price in the most advantageous market will be the fair value measurement only if there is no principal market.
So let me see if I get this. If there's a principal market like the NYSE for a big stock, you use that price. Ignore transaction costs for the value itself. But if there's no main market, you look at different, maybe smaller markets. You figure out which one gives you the best net price after costs.
Right.
But then for the actual fair value number, you use that market's price, but without subtracting the cost you just used to find it.
You've got it. That's exactly the logic. It's a common point of confusion, but that's how it works.
Okay, that distinction is key. Principal market rules. If none, find the best net deal, then take the gross price from that market.
Perfect summary. Let's walk through an example. Example 1 involving Foxyco stock to really cement this and make it much clearer. Okay, imagine Gertie Inc. holds stock in Foxyco. This stock trades on 2 exchanges, both of which Gertie Inc. can access, the New York Exchange and the London Exchange. Now, let's look at the data at a specific measurement date. On the New York Exchange, the quoted stock price is $52 per share. Transaction costs to sell there are $6 per share. So the net proceeds to Gertie would be $46 per share. $52 minus $6.
Okay, $52 gross, $46 net in New York.
Right. On the London Exchange, the quoted price is $50 per share. Transaction costs there are $2 per share. So the net proceeds would be $48 per share. $50 per share.
$50 gross, $40 net in London.
Got it. Okay. The task is to figure out the fair value of Foxy stock under 3 scenarios. 1, New York is principal. 2, London is principal. 3, no principal market exists. Let's go through it carefully. Scenario 1. If New York is the principal market, easy one. Fair value is simply the quoted price in that principal market, $52. We ignore the $6 transaction costs for the final measurement. Principal market price rules.
$52. Good.
Scenario 2. If London is the principal market, same logic. Fair value is London's quoted price, $50. Again, those $2 transaction costs are ignored for the fair value number itself.
$50. Right.
Scenario 3. If there is no principal market, now we need to find the most advantageous market first. How do we do that? By comparing the net proceeds after considering transaction costs. New York's net proceeds were $46. London's net proceeds were $48.
So London gives a better net result. $48 is more than $46.
Yeah, exactly. Since $48 is greater than $46, London is the most advantageous market because it provides the highest net proceeds for selling the asset. Therefore, if there's no principal market, the fair value will be the quoted price from the most advantageous market, which is London's quoted price of
$50.
$50, exactly. Notice, even though we use the $2 transaction cost to identify London as the most advantageous market, we still do not include that $2 cost in the final $50 fair value.
Okay, that example really clarifies the rule. Find the best net market, then use its gross price. But this still raises that question. Why is that distinction so important? Using costs to find the market but not on the price. Why the separation? It feels a bit counterintuitive.
It's a great question, and it gets back to the fundamental definition. Fair value is the price received to sell or paid to transfer. It represents the inherent value of the asset or liability itself, as determined by the market, before any specific costs related to your particular transaction. Transaction costs are different. They're incremental costs directly tied to entering or exiting that transaction.
Yeah.
They're expenses of doing the deal, not components of the asset's inherent value.
Yeah.
Think of it like buying a house again. A house has a market value, say $500,000. That's its fair value. The real estate agent's commission, legal fees, appraisal fees, those are separate costs you incur to complete the purchase or sale. They don't change the underlying market value of the house itself, right?
Right. The house is still worth $500, even if I paid extra fees.
Exactly. You still own a $500,000 house. Similarly, for fair value reporting, we want that pure, untainted market price of the item. Transaction costs are reported elsewhere as expenses of the activity, the cost of doing business. They don't belong in the reported value of the asset or liability itself.
Okay, separating the item's value from the cost of trading it. That makes more sense now.
Good. Moving on, let's thoroughly examine this compelling concept of highest and best use. Now remember, this concept is highly relevant specifically for non-financial assets, things like land, buildings, machinery. Not for financial instruments like stocks or bonds.
Right, physical assets.
Yes. The fair value measurement of a non-financial asset takes into account a market participant's ability to generate economic benefits by using the asset in its highest and best use, or by selling it to another market participant that would use the asset in its highest and best use. Now, the starting point, the presumption, is that a reporting entity's current use of a non-financial asset is its highest and best use, unless market factors or other things clearly suggest that a different use by market participants would actually maximize the value of the asset. Think back to that land with the old office building. Its current use is office space. But if new zoning allows for a massive residential skyscraper, that new potential might be the highest and best use. That significantly increases the land's fair value, even if the office is still there and functional.
So you have to look beyond current use to potential use.
Yes, if the market suggests it.
Huh.
And the highest and best use can involve using the asset alone, or maybe in combination with other assets, or even with other assets and liabilities. You might value a piece of land not just standalone, but as part of a larger development project, including infrastructure, because that combined use unlocks its highest value.
Complex. Okay, let's get concrete. The factory example.
Right, the detailed example from the source. Land with a factory. Imagine a reporting entity acquires land with an operational factory on it. Okay. But similar sites nearby have recently been developed for completely different things, maybe new housing or big retail centers, things that are potentially more lucrative. This immediately suggests the factory's current industrial use might not be the land's highest and best use from a market perspective. It's a red flag to dig deeper.
Okay, so you compare scenarios.
Exactly. To determine the highest and best use, you'd compare two valuation scenarios. Comparison 1. Assess the value of the land as it's currently developed for industrial use. Value of the land, the factory building, associated debt, etc. This gives a fair value based on its existing operation.
Value as is.
Comparison 2. Then, assess the value of the land as a vacant site prepared for residential or retail use. Now, this gets complex. You don't just look at what a vacant lot could sell for. Crucially, you have to factor in the costs of tearing down the factory, any environmental cleanup, maybe rezoning fees, and any uncertainties involved in converting the land from industrial to residential or retail ready.
All the conversion costs and risks.
Right. This gives a fair value based on its potential alternative use, including all the costs and risks to achieve that potential. The conclusion. Fair value is determined based on whichever use results in the highest value. This really highlights that fair value for non-financial assets isn't static. It's about understanding not just what is, but what could be if a rational market participant acted to maximize the asset's potential. It's forward-looking.
That factory example really hits home. But what if there's a lot of uncertainty about that rezoning? Or the market isn't sure if that residential development will ever happen because of, say, an economic slowdown? Does that uncertainty impact the highest and best use valuation? Or do we just assume the best case scenario?
That's a fantastic real-world point. Uncertainty absolutely impacts the valuation. While you determine the highest and best use based on plausible, legally permissible, financially feasible alternatives, the uncertainty around actually achieving that highest and best use gets factored into the discount rate or the risk adjustment in your valuation model. If there's a high degree of uncertainty, maybe that rezoning is iffy or the market is weak already. Market participants would demand a higher return or pay a lower price for that potential future benefit. So you don't just assume the best case scenario happens automatically. You discount the future benefits based on the probability and risk of achieving them. Fair value reflects that risk.
Okay, so the potential is there, but it's risk adjusted. Good.
Very important note. The highest and best use concept is not relevant for liabilities and financial assets.
Why not?
Because these items simply do not have alternative uses, and their fair values do not depend on their use within a group of other assets or liabilities. A financial asset, like a bond, for example, is a contractual right to receive cash flows. Its value comes from those cash flows and the issuer's creditworthiness, not from how you might repurpose the bond itself. Similarly, a liability like a loan you owe is a fixed obligation. You don't transform a loan into something else. Its fair value is determined by the present value of its future payments and the associated non-performance risk.
Can't repurpose a bond or a loan. Makes sense. Their nature is fixed, unlike land.
Precisely.
Okay, so we've meticulously defined fair value, its language, characteristics, key terms like orderly transaction, market participants, principal market, highest and best use. Now comes the really practical part. How do we actually measure it in practice? This is where the fair value measurement framework really comes in, offering specific techniques and, maybe even more importantly, prioritizing the information, the inputs we use.
Yes, exactly. U.S. GAAP established this comprehensive framework to bring consistency here. It essentially has two main pillars. First, it outlines the various valuation techniques entities can use. Second, it establishes a robust hierarchy of the inputs that should be used in those techniques. And the overarching goal, the mantra, is to maximize the use of observable inputs and minimize the use of unobservable inputs.
Use real market data whenever possible. Rely less on guesswork.
That's the essence of it. We want to rely as much as possible on real market-driven data that anyone can see and verify, and as little as possible on subjective assumptions or internal models. Also important, if an entity changes its valuation technique, that's treated as a change in accounting estimate, applied prospectively. No need to restate past financials.
Okay, perspective change.
Let's break down valuation techniques first. There are three primary approaches, or you can use a combination. The choice should fit the circumstances and, again, maximize observable inputs. First is the market approach. This uses prices and other relevant information from market transactions involving identical or comparable assets or liabilities. It's often the most direct and preferred method because it's based on actual market behavior.
Like looking up a stock price.
Exactly. Or valuing a house by looking at recent sales of similar houses nearby. It leverages real-world observed prices directly. Very powerful when available. Second is the income approach. This method converts future amounts, including cash flows or earnings, to a single discounted amount. Think of it as predicting the future benefits an asset will generate or a liability will require, and then bringing those future amounts back to a present value. You use a discount rate that reflects risk and the time value of money.
So projecting future profits and discounting them back.
Right. Commonly used for valuing entire businesses, long-term projects, complex financial instruments, where future cash flows are the main driver. A discounted cash flow, or DCF model, for a business falls squarely in this category. And the third is the cost approach. This technique uses current replacement costs to measure the fair value of assets. It essentially asks, how much would it cost today to replace the asset with a new one that offers comparable utility, age, and condition?
What would it cost to rebuild it or replace its function?
Precisely. This is useful for specialized machinery, custom-built structures, unique equipment where market transactions might be rare or non-existent. You estimate the cost to build a comparable replacement, adjusting for depreciation or obsolescence.
Okay, market, income, cost. Three main ways to get to the number. Now, this is where the trustworthiness of your data really comes into play. You mentioned inputs. Not all inputs are created equal, right? And the framework gives us this clear pecking order, the input hierarchy, like a quality control system for your valuation data.
Exactly. B, the input hierarchy prioritizes the inputs used in those valuation techniques. It's a three-tiered system. Level 1, Level 2, and Level 3. Level 1 inputs have the highest priority, and Level 3 inputs have the lowest priority. And here's the crucial point. The fair value measurement's overall level in the hierarchy is determined by the lowest level input that is significant to the measurement.
The lowest significant input dictates the whole level. Wow.
Yes. So even if you use tons of Level 1 and Level 2 inputs, if just one significant input is Level 3, the entire fair value measurement is classified as Level 3. This really pushes entities to always try to use the most observable data possible because it directly impacts the perceived reliability of the reported fair values. A level 1 value is seen as much more reliable than a level 3 value.
Okay, pressure to use the best data. Let's break down the levels. Level 1.
Level 1 inputs. The gold standard. Most reliable, highest priority. The definition is very specific. Quoted prices in active markets for identical assets or liabilities that the reporting entity has access to on the measurement date.
Quoted prices, active markets, identical items. What's an active market?
Think major stock exchanges like the NYSE, where prices update constantly, or large dealer markets where banks are continually quoting prices for bonds or currencies. It's a market where transactions happen frequently and in volume, providing ongoing pricing info.
And why are these the best?
Because they're directly observable, frequently traded, and represent a real-time consensus of many independent market participants. There's very little judgment involved. When available, level 1 inputs must be used. They provide the most objective and verifiable measure. If you see the price of an identical stock trading every second on a major exchange, that's your fair value. Simple as that.
Okay, level 1 is clear-cut. What about level 2?
Level 2 inputs. Observable, but with a catch. These inputs are still observable, but they're not the direct, real-time, identical market prices you get with level 1. Level 2 inputs are defined as inputs other than quoted market prices, level 1, that are directly or indirectly observable for the asset or liability. They often require a bit more judgment or adjustment. Sure, things like quoted prices for similar assets or liabilities in active markets. So maybe you can't find a direct quote for the exact vintage car model, but you find prices for a very similar make, model, and year that sold recently. You'd use that and maybe adjust slightly for differences. Similar item, active market.
Or quoted prices for identical or similar assets in markets that are not active. Think of that rare piece of art. Maybe it sold 5 years ago, so you have a price, but the market isn't active. It's an observable price, but needs adjustment for time and market conditions.
Identical item, but inactive market.
Also, inputs other than quoted prices that are observable. Things like publicly available interest rates, yield curves, credit spreads, implied volatilities from options markets. These are observable data points you can plug into valuation models.
So observable data, but not a direct price for the item itself.
Right. The indirect nature often means you need to make some adjustments or use models to derive the fair value from these observable inputs. They're a step down from level 1 in purity, but still highly robust because they're rooted in observable market data. Okay, still grounded in the market. Now, level 3, the unobservable realm.
Level 3 inputs. The unobservable realm, the last resort. These are the least reliable, lowest priority inputs, the highest degree of subjectivity, defined simply as unobservable inputs for the asset or liability.
You mean?
Meaning these inputs reflect the reporting entity's own assumptions and should be based on the best available information. The company doing the valuation has to make its own judgments because there's simply no observable market data to rely on.
So when would you ever use these? Seems risky.
You use them only when there are no observable level 1 or level 2 inputs available, or when obtaining observable inputs would require undue cost and effort. It's truly a last resort. Common examples include valuing private equity investments that don't trade publicly, right? Or unique intellectual property, or highly illiquid complex financial instruments with no active market or similar comparables.
Things where there's just no market price to look at.
Exactly. Because these inputs are unobservable, the fair value measurement relies heavily on internal models, forecasts, and subjective judgments about future cash flows, growth rates, discount rates, things like that. This obviously emphasizes the subjectivity. It highlights the need for rigorous internal models and very transparent disclosure of these assumptions because manipulating them could significantly alter the reported fair value.
That makes perfect sense. So if a company is using level 3 inputs for something significant, how do they manage that inherent subjectivity, given the lack of objective data? Are there specific checks and balances they have to put in place to ensure those unobservable assumptions aren't just, well, wishful thinking?
That's a critical point for level 3, and you're right, they require a lot of rigor. Companies typically establish pretty robust internal governance processes around this. This often involves things like 1. Expert judgment. Relying on highly experienced valuation professionals who really understand the specific asset or liability and the relevant market dynamics. 2. Internal models. Developing sophisticated internal valuation models. These models should be regularly reviewed and validated, often by independent internal groups or even external parties, to ensure they're sound.
Okay, model validation.
3. Sensitivity analysis. performing extensive sensitivity analyses. This shows how the calculated fair value would change if key unobservable inputs like those growth rates or discount rates we mentioned were slightly different, maybe 1% higher or lower. This highlights the range of possible outcomes and the inherent uncertainty. It shows how sensitive the value is to the assumptions.
Shows the potential wiggle room.
Exactly. And 4, backtesting. Where possible, comparing past level 3 valuations to actual subsequent outcomes, like if a private investment is eventually sold, to see how accurate the initial assumptions were and refine the models over time. The whole goal is to ensure that even though the inputs are unobservable, the process for deriving them is systematic, well-documented, and defensible, trying to provide as much credibility as possible to that final level 3 number.
Rigorous process to compensate for subjective inputs. Okay, so once fair value is meticulously measured using these techniques and the input hierarchy, it doesn't just sit in a black box somewhere on a spreadsheet. Transparency is absolutely vital for financial reporting, right? And that's precisely where fair value disclosures come in. It's how companies kind of pull back the curtain for investors and the public.
Indeed. The objective of fair value disclosures is really clear: to provide users of financial statements with information about assets and liabilities measured at fair value.
Right.
And why is it so crucial for investors, analysts, lenders, stakeholders? Well, because it builds trust. It enhances understanding. It allows them to assess the reliability of those fair value numbers. Without these disclosures, you wouldn't know if a company's reported assets were valued based on active, observable level 1 market prices or, highly subjective level 3 internal models. That difference fundamentally changes how you interpret a company's financial health.
You need to know how they got the number, not just the number itself.
Exactly. The disclosures aim to provide several key pieces of information. 1, they explain the valuation techniques and inputs used. This includes the significant judgments and assumptions the entity made. This lets users understand the methodology. Was it market, income, or cost approach? What were the key inputs? 2, they highlight the uncertainty in the fair value measurements as of the reporting date, acknowledging that not all measurements are equally precise. A level 1 value has very little uncertainty. A level 3 value inherently carries much more subjectivity and potential variability. Disclosing this helps users gauge the potential impact of future changes.
Manage expectations about precision.
Right. And 3, they show how changes in fair value measurements affect the entity's performance and cash flows. This directly links the valuation to the company's reported profit or loss and its overall financial health. If a big investment's fair value drops, these disclosures clarify how that hits the bottom line, provides a dynamic view.
Connecting the dots to the income statement.
Exactly. Now, specifically, entities have to provide several detailed disclosures. They must provide quantitative information about significant unobservable inputs, level 3. This means putting actual numbers to the assumptions, disclosing the specific discount rate used in a level 3 model, or the projected growth rate for cash flows. This gives users a peek into the subjective elements.
Sharing the key assumptions.
Yes. They also need to include a discussion of the sensitivity of level 3 measurements to changes in those unobservable inputs. This is incredibly insightful. Remember the sensitivity analysis. This disclosure tells users, if that growth rate assumption was 1% higher or lower, how much would the fair value change? This reveals the potential volatility, maybe even fragility, of level 3 measurements. Shows how a small tweak in an assumption can lead to a big difference in reported value. It's a powerful tool for understanding risk.
Shows how much faith to put in that number.
Kind of, yes. Also, information about non-financial assets and liabilities where measurements differ from highest and best use must be disclosed. Back to the factory example. If the company values the land based on its current factory use, but its highest and best use, and potentially higher value, is actually residential, they need to disclose that difference and its implications. Gives users the full picture of the asset's economic potential. And finally, the hierarchy level for items that are not measured at fair value on the balance sheet but are disclosed in the notes must be detailed. Some things might be carried at cost on the balance sheet but still require fair value disclosure in the footnotes for transparency. You still need to know if that disclosed value is level 1, 2, or 3.
Okay, lots of transparency required, especially for level 3. Let's put this into practice with another real-world example, see how these concepts come together tangibly.
Excellent idea. Let's look at example 2, involving Marker 8 Company's investment in Millage Inc. stock, a very common scenario. The facts are, during the year, Marker 8 Company bought 3,000 shares of Millage Inc.'s common stock. At the time of purchase, the stock was trading at $24 per share. So Marker 8's original cost was 3,000 shares times $24,
$72,000.
$72,000.
Yeah.
Now, fast forward to year-end. The quoted stock price for Millage Inc. at year-end on the public exchange where it trades was $21.50 per share.
Okay, the price went down.
It did. So what's the fair value of Marker 8's investment in Millage Inc. stock at year-end? It's simply the number of shares times the current quoted price. 3,000 shares times $21.50 per share, which equals $64,500.
$64,500.
Now, let's calculate the change and talk about the accounting treatment, because this is where it hits the financial statements. Original cost was $72,000. Fair value at year-end is $64,500. That's a decrease of $7,500. $72,000 minus $64,500.
Right.
Marker 8 must record a $7,500 adjusting entry. This entry decreases the value of the investment asset on the balance sheet down to its fair value of $64,500 at year-end. Financial statements need to reflect current market worth, not just history.
Adjusting the balance sheet value down, where does the other side go?
Good question. The other side of this entry, the $7,500 decrease, will typically affect net income directly. Under current accounting rules, changes in the fair value of equity securities like this are often reported directly in the profit or loss statement. This is why fair value adjustments can be so impactful. They directly hit the company's reported profit or loss for the period, giving investors a real-time view of how the market is valuing the company's investments.
Wow, so that $7,500 loss flows straight to the bottom line just because the market price changed. That's a perfect illustration of how these principles aren't just theoretical, it's truly a real-time reflection.
Exactly.
Yeah.
And connecting this back to the concepts we've discussed, this is a perfect example of the market approach in action, right? Using the identical asset's public market price.
Right.
And because that market price is from a public exchange, an active market, identical asset, it's a clear cut.
Level 1 input.
Level 1 input, the most reliable kind. This example beautifully shows how the theoretical framework applies to a common financial transaction, directly influencing reported financial performance.
Okay, as comprehensive and frankly robust as this fair value framework seems, are there ever times when fair value just can't be measured or when it's simply not required? It seems like such a cornerstone of modern accounting, but are there genuine limitations, exceptions to the rule?
That's an excellent question. And yes, there are indeed specific, pretty narrow circumstances where entities are exempt from the requirement to measure fair value. And importantly, these are not loopholes to avoid transparency. They are genuine practical limitations, and the framework wisely acknowledges them. There are three main exceptions. One, an exception exists when it is not practicable to measure fair value.
Meaning, just too hard.
Basically, yes. It means that for some reason it's just too difficult, or perhaps even impossible, to come up with a fair value measurement given current technology, available information, or the very unique nature of the asset or liability. Could be due to extreme illiquidity, a complete lack of data, inability to even hypothesize market participants. It's simply beyond current measurement capabilities in that rare case.
Okay, truly impossible to measure.
Two, an exception applies when fair value cannot be reasonably determined. In this scenario, even if you try to measure it, the range of possible fair values is just so wide, or there's such a complete lack of consensus among potential market participants, that any single number you might come up with would feel arbitrary and potentially misleading, too speculative to be reliable.
The range is just too huge to be useful.
Right. And third, fair value measurement is not required when fair value cannot be measured with sufficient reliability. This is closely related to the last point. If the inputs you have are way too speculative, or the models you'd have to use are too unproven and produce highly variable results, the resulting fair value might be highly uncertain and not truly representative. It just wouldn't meet the standard of credible, decision-useful information.
Not reliable enough for reporting.
Exactly. And it's critical to understand why these exceptions exist. They're there to prevent arbitrary or misleading valuations from appearing on financial statements when genuinely reliable data or methods simply aren't available. The goal of financial reporting is useful, credible information. Sometimes a fair value number wouldn't meet that bar. In these rare cases, other accounting methods, often based on historical cost lists, any impairment, are used instead, and the company must disclose why fair value wasn't applied, maintaining transparency even then.
So exceptions are rare, and for good reason, lack of reliability. Wow, what a deep dive. Seriously, I feel like I've just gained a whole new lens to view financial statements. You now know that fair value isn't just some random number, it's this meticulously defined, market-based, exit price, determined in specific markets through orderly transactions between knowledgeable market participants. We've explored the strict hierarchy of reliable inputs from that gold standard level 1 down to the subjective but sometimes necessary level 3. And we've seen how fascinating concepts like highest and best use apply to non-financial assets, and why seemingly small details like transaction costs are handled with such, well, precision.
And if we connect this to the bigger picture for you, the listener, understanding fair value allows you to look at financial statements with a much more critical and informed eye. You can now appreciate the rigor, the thought that goes into valuing everything from a highly liquid share of stock to a complex piece of land with a factory on it that might actually be worth more as a residential development. It's a fundamental lens through which to view economic reality and assess a company's true financial health.
Absolutely. So, next time you see a for sale sign on a property in your neighborhood, or maybe you're scrolling through a company's financial report mentioning its asset values, take a moment, consider, what's its true fair value in the market right now? Is it based on its highest and best use? Is it a level 1 price that's clear as day? Or is it based on more subjective, unobservable level 3 inputs? What assumptions are you making about its worth, and what assumptions are the financial reports based on? That kind of critical thinking, I think, is invaluable. We really hope this deep dive helps you navigate the world of financial information with greater confidence and maybe even a bit more curiosity. Until next time, keep digging for those insights.